Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. There's a ton going on in the world right now, and much of it impacts real estate investors. Today, we'll dig beneath the headlines and take a look at what's happening and how it influences you as a real estate investor. It's Clues in the News, today on the Real Estate Guys radio program. If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investors Summit. Simply put, it's the highest level event we do, and the content, faculty, and attendees are amazing. If you're serious about taking your real estate investing to the next level, then join us next summer. You'll spend an entire week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all begins June 6, 2023 in Ambergris Caye, Belize. Visit realestateguysradio.com and click on the tab that says Summit to learn more and reserve your spot. We'll spend a sun-drenched week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. It's nearly 70% full already, but there's room for you if you go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 21st Annual Investors Summit on Sand. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, in the co-host seat, it's Russell Gray.
Hey, Robert.
We love to scour the headlines and find out what the world's thinking, but at the same time, you got to dip a little bit beneath the headlines, and every now and then we do what's called Clues in the News, and I'll tell you, we are not starved for news these days.
No, there's so much going on with inflation and the economy and the price of oil, the friction in the market with increasing regulation, of course, higher interest rates. We've got a jobs report that have come out that was a little bit or a lot less than expectations in terms of job openings. So the list goes on and on. I think one of the couple of things that are really important for real estate investors, one is just to remember that what goes on at the macro level is the sea that you're investing floats in. And so if you don't understand the waves, if you will, the weather, then you can be sailing into a storm and not even see it coming. I know I speak from experience. It's what happened to me in 2008. And so to understand that, you have to have a basic understanding of the way the financial system works. And so that's really, really important. And the other thing is you have to pay attention to the news. There's a reason these financial media outlets, whether it's the Wall Street Journal or Market Watch or Business Insider or some of these alt media sites that cater to investors, at the end of the day, everybody's paying attention because they are trying to read the tea leaves. And so often you look at the headlines, you don't even know what they mean. And so you can't even understand what's being said. So you can be staring right at a problem coming right at you and you can't even see it. So one of our missions on this show, Education for Effective Action, is to help Main Street investors understand what goes on Wall Street and in the macro and how that affects your Main Street investment decision making.
So you'll want to stay with us today because we're going to break down some of the more recent news and headlines in a way that will help you understand as a real estate investor. Remember, most of the news that's out there, if they mention housing at all, they're talking about single family homes. And when they talk about broader picture economics, they're not talking to real estate investors. They're talking to stock investors, market investors, and so on. But I think, Russ, let's start with a unique thing that happened in the market and break it down for real estate investors. And that's what happened with the Bank of England.
Yeah. So we'll start with the headline, which probably a lot of people, and if this was me 10 years ago, I wouldn't have known what it meant. But the Bank of England came out and they reversed course. So they were like the Federal Reserve here. Just so you know, the Bank of England is the central bank of England, just like the Federal Reserve is the central bank of the United States. Everybody's been working to get inflation under control. And so they've been talking hawkish or tightening, raising interest rates, tightening up their activity in the market, tightening the money supply with the idea of trying to cool down inflation. But the Bank of England came out and just did a complete 180 and went in the other direction. And so if you see a lot of green lights going on in the stock market and the bond market and everybody diving in, gold, oil, Bitcoin, everything's up, at least as of when we're recording this. And the reason that is because people are coming out of cash, believing it's now risk on, meaning the Fed is going to be printing a bunch of money following in the lead of the Bank of England. One of the things that we've seen happen is, as a result of that, the bid on bonds, bid bonds up, drove interest rates down. And so we may see a little bit of dip, at least in the short term, in mortgage rates. So that's kind of how it relates back to real estate investors.
Well, this is a really important point. People hear about the Fed raising rates. And again, not probably one investor in 10 knows what that really means, but it doesn't mean they're raising interest rates. That's different. And we saw the first time, a couple months ago, we had a 75 basis point increase. Mortgage rates went down. This time, this most recent time, with the 75 basis point increase, mortgage rates went up. So that's confusing to folks. So let's talk a little bit about why that is.
Yeah, so when the Fed sets their interest rates, they're doing a couple of different things. One rate they control is the rate they pay banks on interest reserves. And so they discourage lending by paying banks more interest to park their reserves at the Fed. They make it harder to borrow. Of course, as real estate investors, we care about that.
Yep.
The other thing they do, though, is they are signaling how they plan to manipulate the bond market because they're a big player, the biggest player in the bond market. So they step into the bond market, and if they buy bonds, then they bid up the price of the bonds. They drive down interest rates. And the Fed has been doing quantitative easing or bond buying for a decade to the tune of over $1 trillion a year. And some of that has been mortgage-backed securities. And we've seen a lot of that air, if you will, or a lot of that money, that purchasing power make its way into real estate. And as a result, equity has happened. And we all think, oh, this is great. Equities happen. And so that's fine. If they go the other direction, which is quantitative tightening, they're pulling money out. And so what the stock market investors do is they look at that and they're like, okay, do we want to be invested in stocks? If there's going to be easy money, then it's going to be good for stocks. And so that's risk on. So in the free market, the individual market, they sell bonds and they move into stocks. So when you sell bonds, you lower the bid on bonds. It actually raises the interest rates. And if the Fed's doing the same thing, then rates go up a lot. And that's money moving into the stock market. Right now, everything's been going down. And that's because people have been so nervous, they don't know what's going to happen. And so they're just sitting in cash. And there's been a big bid on dollars because people want to sit in cash. And so if you follow the currency part of it, you realize that the US dollar is like at a 20-year high right now. And you look at the damage that does around the world. The Japanese yen, very powerful currency, one of the major currencies of the world, is now at like a 23 or 24-year low versus the dollar. So it isn't that the dollar is strong in any way that really matters, because when you go to the gas pump, when you go to the grocery store, when you go to pay your rent, when you go to buy a piece of property, buy a car, whatever it is you're going to go do, you're paying more dollars, which means it takes more dollars to buy the same stuff. That's the dollar losing purchasing power, being weak in the real world. But in the financial markets, it's strong compared to other currencies that are falling faster. So I know that's heady stuff.
But it's an important point. This is an important point to get at, because you'll see in the media, the dollar's strong, the dollar's strong, the dollar's strong. A friend of ours who is an economist came out and said to us on an email, what are you guys talking about, dollar demise? Like that's not going to happen. The dollar's so strong. But it's compared to the other fiat currencies that the dollar's strong. To your point, Russ, everywhere that matters, it's not. And this is hard to get your head around. It's, again, the way stock market investors and funds and REITs and all those folks think differently about it than Main Street investors.
Well, I mean, let's step back and say, why does all this matter, right? Because if you're struggling with this, you're like, why would you want to listen to this or listen to it 2 or 3 times and try to understand it? Because your tenants live on Main Street.
Yep.
Because your tenants have to pay more for gas. Because you think in your pro formas that you're going to be able to raise rents. And so you're counting on inflation to help you make money in real estate. That's why you invest in real estate. That's the whole thesis behind our book, Equity Happens, is the idea that the currency regime, the way the financial system works, requires a never-ending expansion of debt. And it doesn't matter if Republicans or Democrats, it doesn't matter. They all say, oh, we need to cut the debt, we need to cut the debt. But none of them will, because they can't.
Right.
And once you realize that failure of the dollar over the long term is certain to occur, there's 2 things. One is you want to invest accordingly, and real estate is one of the best ways to do it. And the second thing is you want to watch, because the day could come where the currency completely fails. And I know that seems like that's impossible. If you're young and you don't even study history, you probably don't know that before 1944, the US dollar was not the world's reserve currency. The British pound was, and the British pound effectively failed and was no longer able to carry the weight of being the world's reserve currency. And the U.S. took it over in the wake of World War II. So the dollar's tenure as the world's reserve currency has lasted as long or just little bit longer than every other currency that has come before it. And so you have to ask yourself at some point, is it possible? Is it feasible? Is it probable that the dollar's reign as the world's reserve currency could come to an end? And so, you can't live in fear, but you have to live in understanding. And then you watch to see if there's any signs of that happening. And when you see double-digit inflation, that's the dollar failing. When you read the international news and you see that Russia and China and Iran and other major energy producing countries and energy consuming countries and big manufacturing countries, big populations are all working together to de-dollarize, to reduce their global dependence on the dollar at the same time as the U.S. is using the dollar as a weapon, then you realize that if they succeed, and I'm not saying they will, but they're working at it, and it's not a secret. If you read the news, you can see it. If they succeed, you got to say, well, what does that mean to me on Main Street? And if you realize that if I'm holding a reserve currency as an international, like a central bank in another country or a sovereign nation, and I've got reserves in the US dollar, and all of a sudden I don't need them anymore because it's not the world's reserve currency, then I'm going to sell those dollars. When everybody's selling and not that many people are buying, what happens to the value? Value goes way down. And if you think about where are all those excess dollars going to go, well, if the dollars aren't needed in international trade anymore, if the dollars aren't useful as international reserves, where is the only place they're good?
In the United States.
In the United States. So all the dollars come back to the United States to bid on the available productivity in the United States. And when you have huge amounts of dollars chasing limited amount of productivity, the result is hyperinflation.
Yep.
Now, I'm not saying that's going to happen, but I'm saying that it could happen. And if you're not prepared for that possibility, then you can end up like I was in 2008, completely blindsided because something you didn't even understand was actually starting to happen. You had plenty of time to get out of the way, but you didn't even know what the signs were. And that's why we do the show. And that's why I just encourage people. I know it's hard work because I've been doing this for 10 years. But I know that because I've been on panels with really smart people that I've learned from, and I can get into conversations with, if I can learn it, you can learn it too. And Robert, you've been watching for a long time. We go out on a limb and go, hey, this is what we think is going to happen. And, you go back in the archives 10 years and listen to some of the stuff we were talking about is happening right now. And so the people that were able to see it coming and get in position, because everything moves very slowly. That's a positive thing and it's a negative thing. It's positive because you have time to do something. It's negative because you fall asleep at the wheel, because it's not fast enough. We all have ADD, right? It's got to, but the thing didn't happen. Peter Schiff taking crap all the time because, he says, hey, the dollar's unsound, and he's been sounding the alarm for a while. Well, it doesn't make him wrong. It might make him early, but you still have to pay attention. And that's the point. The key is just pay attention. And this Bank of England thing and this Credit Suisse thing, which we can talk about in a little bit, just popped up, that are like just little warning signs that there are tremors in the credit markets. You need to pay attention.
And that is the key. You got to pay attention. Our friend George Gammon says there is no certainty. There's just probabilities. We don't know what's going to happen. We don't have a crystal ball. If we did, life would be easier. But we are paying attention. We want to urge you to do the same thing. A couple of weeks ago, you and I had a chance to hang out in Mexico with our friend Simon Black. Simon did an awesome podcast a few weeks back about what the eventuality of not being the world's reserve currency might look like. And his premise was, do we even need a world reserve currency anymore? What about this idea that, let's face it, there's 190 other countries that don't have the world's reserve currency, and people get up every day and they go to work and they make money and they live and thrive and survive and own real estate. So it's not the end of the world, literally, but things do change. Back to the point of dollars in demand for international trade settlement affects our dollar a ton. If that goes away, then our dollars become worth less. And yet the bid of those dollars chasing up assets is going to have the hyperinflation you talked about. So this isn't to freak anybody out. It's to be prepared. Now, you mentioned Peter Schiff. Last time we had Peter on the show, he was very much of the belief that the Fed was a lot of talk and Powell's going to raise, and that he wouldn't actually do it. Well, lo and behold, when Peter was on the summit, he says, it looks like he's more serious. He is doing it. We are seeing the raise. And now yet, The Bank of England has reversed course.
Well, let's talk about why they had to do it. If you look this article up, and I encourage you to do it, and you read what it's saying, basically what you have is you have the UK pension system that is invested heavily in bonds, which a lot of pension programs do. And because the yields on those bonds were so low, in order to magnify the yield, just like you do in real estate, they levered them. They used debt. The difference between real estate and bond levering is that in real estate, if the value of the property goes down, you don't have to pay down your mortgage to restore your leverage ratio.
No margin call.
There's no margin call. So if you, just to keep the math simple, if you had a $100,000 house and you put $50,000 down, you'd have a $50,000 loan. If the value of that property went to $80,000, in order to have a 50% loan to value, you'd have to pay your loan down from $50,000 to $40,000. So you would have a $10,000 cash call or margin call. That creates a demand on dollars. So that's the way the bond market works. So as long as the bonds stay steady or go up, meaning interest rates continue to drop, you're okay. Well, with this rising interest rate environment we've been in, the bond values have been going down. And this triggers these margin calls. And so no surprise, there's been a big bid on dollars. But in the UK, these pension funds were literally on the verge of insolvency, which would have destroyed all these pensioners. So the Bank of England had no choice but to step in and pledge whatever it takes, we're going to save this, which is a complete pivot from tightening to extreme loosening, even though there's inflation. And Britain's inflation is worse than the United States. So the world looked at that and went, wow, well, okay, if the Bank of England just got backed into that corner, probably the Federal Reserve is going to get backed into that corner. Great, party's on, more loose money coming, charge into the markets and ride that wave. And so we're seeing some of that. Now, what's the Fed actually going to end up doing? I don't know. And maybe when we come back, we can talk a little bit about why rising interest rates crushes bond values and triggers all these problems.
It's clues in the news, what's happening in the headlines, and what it means to you as a real estate investor. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2023 Goals Retreat, January 6th through 8th in beautiful Lake Las Vegas, Nevada. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at realestateguysradio.com under events or call 888-489-7723, extension 18. Get your life back on track, physically, spiritually, and financially. Attend the 2023 Goals Retreat on the first weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, this is Kim Kiyosaki. I'm the author of Rich Woman, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you want to see an awesome real estate market up close and personal, well, then join me for our Belize Discovery trip. It's a beautiful part of the world. You can get all the details on our December trip at realestateguysradio.com. Under events, you'll see the Belize Discovery trip. It's clues in the news. We're looking at what's happening in the headlines, and things are moving so fast. It's just crazy. And I think as a real estate investor, the tendency to want to put your head in the sand and just think about real estate is something you have to overcome and pay attention to the broader picture.
Well, and you just mentioned the Belize field trip, and I think that that is really relevant to this conversation because it's a market where there's not a lot of debt. And even though we love equity, equity's awesome, equity is fake. The value is the asset itself. If I have a 3-bedroom, 2-bath house, whether it's paid for, whether it's worth $50,000 or worth $1 million, at the end of the day, it's still just a 3-bedroom, 2-bath house. So in terms of its real utility, the number doesn't matter, right? And so what matters is what does it mean to a human being? What is the use of it? And so when the value, a big part of the value is based on the fact that credit is easy and people can get mortgages and bid up the price of a home. If you bought a home early in that cycle, you're going to have a lot of equity. But if those credit markets break, as they did in 2008, all that air, if you will, comes out of the jump house and the properties drop in value. And so if you look back historically at markets like Belize, which we were in back then and still are, because there was no debt in the market, in 2008, the Belize market maybe dropped a couple points. It barely moved because nothing really changed there. People were still cash buyers and there was not a lot of air to come out of the market. Texas, which had more stringent rules about loan to values and cash out refinances, fell some, but not as much as places like California, Arizona, Florida, where there was lots of leverage and cash out refis and just a lot of air in the system. So if you understand that the credit markets, because of a rising interest rate environment, are in jeopardy, they could break. And if they were to break to the point where mortgages weren't readily available or very, very costly, we're already seeing some of that, the result is some of the air comes out of the value. And so where do you hedge? If you still want to be in real estate, you want to pick markets where you don't have as much exposure. And of course, when in a place like Belize, you're not even exposed to the U.S. economy. It's a very different environment. I'm not saying it's better. It's just different. And sometimes diversification. So, it's why we've been touting it for a long, long time. We got interested in offshore before the crisis. And then after the crisis, we became uber committed to it and have been promoting real assets and international as a strategy just to insulate yourself. So this is really what we're talking about. It's a dollar. A lot of American investors can't think outside the dollar. They denominate everything in dollar. And if the dollar goes bad, do you even know how to think about values if the dollar is not a good unit of measure, right? That's a whole different discussion.
Well, it was a discussion we spent a lot of time on this year's summit, what we call capitalism without currency, which is something to get your mind around. But value, you mentioned the utility of a 3-bedroom, 2-bathroom house. It's the same utility no matter what happens to the price. We were just at the Bigger Pockets conference, and I met a gentleman who saw me do a talk at Michael Blanc's event and said, wow, what changed my whole outlook is you talked about wealth was not dollars. Wealth was doors. Wealth was ounces of metals. Wealth was barrels of oil. That's wealth. Houses are wealth because they produce cash flow, whatever that looks like. And that is what, as real estate investors, we're interested in. So if the premise is there's going to be a demand for real estate, it's going to be worth more in 20 years than it is now, then your mission is to figure out how to get more of it. And when times change, you stay close to what's happening in the market. Let's talk about interest rates because in the U.S., a lot of investors at the conference this last week were like, oh, wow, interest rates are 5.5%, 6.5%. I think I'll just wait.
So I have this conversation a lot with people, and you have to just think through all the different scenarios. It's like playing chess. Okay, if I make this move, what happens? If I make that move, what happens? Back and forth. Think about it. If you get a mortgage today at today's high, quote unquote, rates compared to what you might have been used to the last couple of years, which were historically low, and you get the mortgage and rates go up, you're going to be really happy that you got the mortgage at today's high rate because compared to tomorrow's even higher rate, today's rate's going to look real good.
Yep.
Now, let's say if you get the mortgage at today's high rate and rates go down, you're going to be really happy that you have the mortgage because you're going to have control of a piece of property that's probably going to appreciate quickly because of lower interest rates bringing more purchasing power. And then you can refinance your mortgage because you already locked in your purchase price. Okay. So you're going to be happy. If you don't get the mortgage and you don't get the property, whether rates go up or go down or real estate goes up or down, doesn't matter to you because you're not in the game. So I don't want anybody to think, you need to stay on the sidelines. What I'm saying is if you buy a property, make sure that it makes sense in your ability to be able to maintain control of the property, which means control of the mortgage, even if you're upside down. Right? So to your point, Robert, it's all about cash flow. And that's going to come down to really your local market, the niche you choose, the demographic and local economics, and the supply and demand dynamic in that market. And this is where you have to shut off the talking heads on TV who try to talk about real estate in the macro. Because real estate is not macro. Real estate's not a commodity. It's not an asset class. Each individual deal, each individual neighborhood, each individual ownership structure, financial structure is unique. And so the key is if you say, well, I'm going to take this thing at break even or negative cash flow, very thinly capitalized, I'm going to put all my capital into it and trust that it's going to go up or I'm going to be able to push the rents. And if that doesn't happen and you maybe have an adjustable rate loan or a short term like a balloon loan because you're just in by your fingernails, then you just need to be prepared to get your rear end handed to you. Not saying it will happen, but you're a lot more vulnerable. So the key is in a market like this, if you see an opportunity to put a deal together that makes sense and you feel like I can control this for the next 10 years, well, do the deal. And get the mortgage because for all the reasons I said before, if it goes up, you're going to be glad you did. If it goes down, you're going to be glad you did. Where you're going to regret getting the mortgage is if you can't control it for the long term. So the difference between investing and speculation is having a real serious plan for cash flow. Nobody's saying, hey, I'm going to get rich on cash flow. We said in Equity Happens, reserves preserve and cash flow controls. And cash flow is what gives you the ability to control the asset. Reserves are the cash reserves you have that give you the ability to get through small disruptions in cash flow. But if you just pick something and say, oh, cash flow's for the birds, right? I'm just going to buy and trust inflation to do what inflation does. You may be surprised if somebody trips over the cord to the jump house and the credit markets break again. And so, of course, we were on the summit this last June, and I got a chance to ask Daniel DiMartino Booth, and I talk about this all the time because it was my biggest takeaway. And I said, Daniel, 9 years inside the Fed, she probably knows the Fed's thinking and inner workings and personality and mission better than anybody I've ever personally spoken to. And she says, I asked her, I said, it's said that the Fed is going to raise interest rates until something breaks. Do you agree or disagree? And if they are, what will break? And she goes, I absolutely agree. And it'll be the credit markets. She didn't even hesitate.
Yeah.
And I went, okay, well, that's, deja vu all over again, because that's what happened in 2008, even though in 2007, then Fed Chair Ben Bernanke famously went on record going, oh, the subprime crisis is, largely contained and we don't foresee any recession or any chance of it affecting the credit markets. And of course, it was an absolute train wreck.
Yeah. Oops. Talk about getting it wrong. And that's the other thing. It's always people interpreting what they see and hear. For instance, you mentioned the jobs report. So we've heard for the last little bit, and anybody anecdotally knows that it's hard to find good employees, that unemployment is at a low, and yet last week the jobs report came out and it wasn't good.
Well, so the whole stats, just like the CPI, it's sad, but the stats are so manipulated to try to fit a political narrative, and both parties or whoever's in control are all responsible. So you really have to think things through. There's a thing called the labor participation rate. And so if you can imagine, George Gammon says this all the time, let's say there's 1 million people in the economy, but we deem that 999,999 are all, for whatever reason, have decided to opt out of the labor market, right? They're not looking for work. Therefore, if only the one person has a job, we're at 100% employment, we're full employment. But that economy is not healthy.
Right.
You have to consider, just because you have high employment rate, what is the high employment rate applied to? The total population or just the people that are allegedly participating in the economy? And so that's one thing. And then there's job openings, right? So is the labor force tight, meaning that are there lots of job openings available to the size of the workforce? And so when you can kind of manipulate your numbers, you can create stats that you want. Yes, on Main Street, it's hard to find people to come to work, but that's because a lot of people have been paid not to work.
Yeah.
They're living down on their stimulus or their savings because, they're being a little bit pickier. I think people are coming out of the woodwork. And the other thing is a lot of the jobs that have been created, to be candid, and I'm not throwing shade at anybody, but I'm just saying, you shut down a whole economy and you kill millions of jobs, and then you bring back, 1 million jobs. You haven't even gotten back to where you left off at. And we may be there. I mean, I don't study that because at the end of the day, that's all macro stuff and it doesn't matter to a real estate investor. Who cares? What I care about is what's going on in the market where I'm investing, in the product niche I'm investing in. I want to go talk to a property manager. How many people are applying for the openings, right? How many vacancies do we have? How quickly does it take to fill the unit? If you had more of the right kind of inventory to satisfy this demand, what would that look like? And they tell me, okay, that's a point on the curve. Now I'm going to go look in the economy. Are the types of employers that are bringing those types of jobs, are they moving in or are they moving out? Are more people moving in or moving out? And you begin to work the case back kind of anecdotally. It's why we do the field trips, and not so much to do it because we don't have time to go look at all the markets ourselves, but just to teach people how to go into a market and actually look at something at the street level and get your head out of some of these stats. The stats are important, but they're the beginning. They're not the end of the analysis. What's going on when your thumb is on the pulse of the conversation on the street level, to me, is where it matters. And that property manager, that person, that guy or gal who knows how long the waiting list is, the quality of the applications, the direction of the rents, whether they can push them or whether they're having to make concessions, what the competition is doing, how many units are available right in your little neighborhood. You're never going to get that on stats. You're going to have to go into the market, build a team, and trust your team to give you direction on which properties, which neighborhoods, which configurations are going to work best, and then based on those cash flow projections, work into what you can do from a financing perspective.
It's clues in the news, what's happening in the world, and what it means to you as a real estate investor. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from December 9th to 12th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 16 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful. And wait till you taste the food. But the real opportunity is the real estate investment potential. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And at Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me December 9th to 12th in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market's interesting to you. But that ball's in your court. You'll receive their contact details, but they won't receive yours unless you give it to them. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on events where you'll find the Belize Discovery Trips. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize December 9th to 12th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under events, and I look forward to seeing you in beautiful Belize.
Hi, this is Sam Freshman, author of Principles of Real Estate Syndication, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you want to have, do, and be more with your life, it's time to get serious and create your future. Come on out to the 2023 Goals Retreat, the first weekend of the new year. It's like no seminar you've ever attended. You can get all the details at realestateguysradio.com under the tab that says Events. It's clues in the news, taking a look at what's happening in the world and what it means to us as real estate investors. Before we get back to the headlines, it's time to play Real Estate Trivia. That's your chance to win a prize by knowing today's Real Estate Trivia question. As soon as you hear the question and think you might know the answer, send your best guess to trivia@realestateguysradio.com. That's trivia@realestateguysradio.com. You want to send us your name, the answer to the question, and your mailing address, because if you're the first one to get it right, you'll get a brand new book called Think Big, a collection of inspiring stories by all kinds of great authors put together by our good friend Kyle Wilson. That can be yours if you know today's real estate trivia question. Last week it was Ask the Guys, and our first opportunity to give away a copy of Think Big, we asked this: name the top tourist destination in the world. You have all the real estate in the world. What's the top place visitors go? Well, the answer is the Eiffel Tower in Paris, France. Built for the 1889 World's Fair, the tower is the most frequented tourist destination, followed by the Colosseum in Rome and Machu Picchu in Peru. Here's our real estate trivia question for this week. Name the 2 U.S. states with birth rates higher than the natural replacement rate. We just learned this fact at the Bigger Pockets Conference this week. There are 2 states that have birth rates that are higher than the natural replacement rate. Which are they? Now, if you only know one, you can send that in too, because if nobody gets them both, the book will go to the listener with the first correct guess. Send that along with your name and mailing address to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. First person that gets it right wins this awesome new book, Think Big. That's today's real estate trivia question. We're talking about what's happening in the world, what's happening in the news. It's coming at us fast. There's a lot of information out there. I guess the overarching message today is don't freak out. Just pay attention, get your head around it. If you can't understand it, then talk to somebody that can help. Listen to this show again, right? We're talking about this stuff in a lot of formats. And at first, when we got into real estate, all we cared about was real estate. And now we see the bigger picture. In fact, one of the things that we heard from an economist this week is that she had a really interesting chart where she showed in and out migration in the states. And the premise was it included no outside migration. It was only people moving within states, which meant that the number of people stayed constant for this exercise. And you saw the states where there were great exodus. Places like New York and California and expensive places that people were leaving. And then you saw the states where there was a big increase in the percentage. And those are states like Texas and Florida and so forth. But one of the points she made I think was interesting is that she said it's not just the percentage, because on this chart was every one of the 50 states in the U.S. and the percentage, whether up or down. She goes, not just the percentage. Think about a big state like Texas, for it to move the needle, and Texas was up, I think, 4.4%. She goes, with a state that big, that's a lot of people. Then look at a smaller state. The number 1 state in terms of in-migration was Idaho. But she said, based on the population, that's not that many people. So it's not just percentage, it's where people are going. As real estate investors, I'm really interested in that. I want to be in a market where there's a reason for more people to move to than away from.
Yeah, well, we talk about that all the time. It's got to be business friendly. It's got to be affordable. It's got to offer great quality of life. It's got to be landlord friendly. You have to have the right supply and demand dynamics at the neighborhood level, and you have to understand what that is depending on what you're investing in. And, if you're doing something that's very dependent on a specific demographic, like residential assisted living, the silver tsunami, right? If you're going to invest in industrial, you've got the trend towards e-commerce and distribution. And I think everybody knows Amazon ramped up and put all kinds of options and bought all kinds of property because the COVID thing really drove their business. And then all of a sudden it pulled back a little bit. And now all of a sudden they're, got too much inventory and they're subleasing and jettisoning properties and canceling contracts. So we learned that back in the Bakken in the day, or in the Go Zone way back when we had the Katrina, and the entire city of New Orleans moved out. And then there was all kinds of incentives to purchase real estate in the adjacent areas because there was so much demand, but it was short-lived. And so you have to look at what these macro trends are, and are they long-term trends? Are they short-term trends? Because, when you're investing in real estate, you're investing in a moment in time where there's a set of circumstances. And if you project those forward like they're never going to change, some will, some won't. Like if you set your financing and you set your interest rate, that's fixed for, if you do like a 30-year fix, what your cost of money is going to be for 30 years. And to the point I made earlier, most of the time in any environment, it's a good bet because either it's going to go higher or it's going to go lower. And in both cases, you win. The key is just to have a property that you can control from cash flow. But there's other things like these temporary situations that create a real spike or imbalance in supply and demand, and create a dynamic. And if you understand that something that made the market crash temporarily is temporary, then you can step in. Like, anybody looking back in hindsight can see when the credit market collapsed in 2008, it was all hands on deck to repair it. And it took time. During the interim, if you had the wherewithal, meaning you either had a network of investors with money, that's why we teach syndication, it was born out of that, or you have gotten liquid the way Ford drew down their credit line, seeing the recession coming so that when it came, they would have cash and not have to worry about healthy credit markets because they took the money when the money was available, not when they needed it in anticipation of the need. Then you're in a position to step in. And then once those markets come back and reflate, you're the proud owner of an asset you bought for pennies on the dollar. If you don't understand why that might happen, then you might not be on the front end of that. So if you're looking at a migration pattern, if a bunch of people leave or come into a marketplace, don't just look at that they came in or they came out. Ask why. Why did they come in? Is whatever that condition that drove that behavior, is that a permanent long-term situation? Is that going to continue? Like we look at Michigan. Detroit, Michigan, at one point in history was the richest city in the world.
Yep.
In the entire world, the richest city in the world. People today, young people are like, Detroit?
Yeah.
Are you kidding me?
What a change.
But that was the automotive capital of the world. The United States was the automotive king of the world. Automobiles was like one of the number one products in the world. And it was the richest city in the world. Through bad policy, they created an environment hostile to industry, and industry left. And pretty soon, this 2 million population city dropped to a population of about 800,000 over a long period of time. So people who didn't understand the dynamic, and that businesses were leaving, and that we were giving up our manufacturing base in the United States, and we were basically ceding our throne as the automotive king of the world to Japan, all this was going on. That real estate market went from being one of the best in the world to one of the worst. And that was a long-term trend. And if you didn't understand what was driving it, you might think, oh, this is, everybody moved out, but they're going to move back in. No, they didn't. So you look at things like what's going on in Illinois. Illinois has been shedding population. It's been the poster child for losing population for quite some time. California.
Yeah.
You have to ask yourself, is the condition that's creating that exodus likely to continue? And of course, we've talked about this in the past. Illinois being the loser, the adjacent state, Indiana, has been the winner.
Yeah.
And so that's turned out to be a decent place to invest because it's been more business friendly, more affordable, more landlord friendly. And people would move because they want to be near their old life, but they just want to get over a state line. Nevada has been the recipient. Arizona has been the recipient of people trying to get out of California. I think to a degree, even Idaho, and people fleeing Washington state. Again, policies. I'm not trying to be political. Because you can agree or disagree. What I'm saying is policies do matter. The environment that the people who create the policies create make an environment where job creators and investors are either going to be welcomed or they're going to flee. And we've lost our manufacturing base, in the United States. That's no secret over the last 40, 50 years, middle class being crushed. And that's rolled down to the students because, the students go get a degree, or they have to get a degree because they have to go do something intellectual to be able to make a living. Because, you couldn't just go get a high school diploma and then go work in a factory somewhere and make a good middle class living because those jobs don't exist. You're either going to be in the service industry or you're going to be in, kind of the white collar business because that's what our economy became. And if you didn't see that trend, you're going to get wrong footed. So, the list goes on and on. So paying attention to the macro is the point of the show. Right now, the big macro thing is in the financial with the credit markets because rising interest rates mean so much more than just, my payments are more. It literally threatens the financial system, meaning the bond market. And I think real estate investors need to get educated on that and pay attention because the rate of the hikes has been so unprecedented. I mean, the UN right now is like, hey, you guys got to do something about inflation. Now they're talking about international wage and price controls. I mean, can you imagine like the UN coming to you as a landlord going, you can't raise rents?
Wow.
Right. The United States government did that, 40, 50 years ago and people don't remember it. But it happened here in the land of the free. So I'm not saying it's going to happen, but it could happen again. There's pressure. People are trying to figure out how to solve the problem. And I think the real answer is just increase productivity, but that's a different discussion.
We're talking about what's happening in the news. We have one more late development we'll talk about next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hi, this is Dennis Waitley, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Hey, if you want to do bigger deals using other people's money, you can learn how to go bigger faster at the Secrets of Successful Syndication, our two-day amazing event. Happens twice a year. The next one in March 2023 in Dallas, Texas. Get all the details by sending an email to syndication@realestateguysradio.com. We like to peel back the headlines and see what's going on. Today, it's another edition of Clues in the News. John Burns Consulting, one of our buddies. He's been a guy who's monitored and helped builders understand broader picture economics for a long time, been a guest on the show. He came out and said, people are watching migration and they're watching new builds, and there is new construction in almost every state right now. But he looks a little further out. He looks at new home permits.
Right.
So before there is a house being built, there's a permit, and permits are actually down.
Yeah. So if you think about it, any salesperson knows that if you are working on lead generation and marketing and you get a flow of business and then you take time out to go service that business and stop that packing your pipeline, they call it, then you're going to have a bubble in your pipeline. And someday down the road, you're going to wake up and not have any customers to talk to because you failed to line those people up. So disciplined salespeople always stay on the front end and take care of their existing clients. And you have to balance that out. Well, the same is true in home construction or any type of real estate, but we're talking home construction right now. So permits that were issued a while ago when interest rates were super low, builder home confidence was way up, those units are coming online and helping with the supply problem. And that's a good thing. The bad part is because of inflation, because of spiking interest rates, because of labor shortages and so much uncertainty. And we've had these conversations anecdotally with boots on the ground builders, is they're curtailing their willingness to go out and start these projects because they can't really pre-sell their inventory, which is the holy grail if you're a developer, because the buyers don't have confidence. They don't know, if they can afford it because you've got the double whammy of higher costs of living and higher interest rates. And the builders are like, I don't know if I can hold the price on this contract to make it more affordable, even if your variables don't change. If I have greater labor costs, if my lumber costs more, if my energy costs more, if the interest rates on my construction loans cost more, if I'm going to have to pay higher taxes, if I have to deal with more regulations. So you have all of these things that are dragging on the activity of home building. And so it shows up in people saying, I'm not going to pull permits. I'm not going to do it. I'm going to maybe bank my land, and I'm just going to wait and take a wait and see until this thing stabilizes. And so that tells me somewhere down the road, there's a bubble coming, and that bubble is going to be not enough supply. And we're already coming off of a not enough supply environment. If you listen to people like Lawrence Yun, the chief economist for NAR. So if we continue to have population growth, or in certain markets, population migration, and, like it or not, we have more people coming into this country. Doesn't matter how they got here, they're here, and there are housing needs. And, presuming that they can find a way to become productive members of society and at least be able to pay rent, that's going to impact demand in different areas. Again, this goes back from going to the macro, taxes, interest, the credit markets, the currency, that's all macro. Supply and demand and niches and migration patterns, that's all micro. And you got to look at them both, not one or the other, but you got to look at them both. That'll tell you where there will be pockets of opportunity. But right now, in the macro, you've got a slowdown in builders being willing to bring new product out of the ground, and that'll make existing product more valuable.
And that's what you have to do, is think how every move affects every other move. I was just at Brad Sumrock's AIM NatCon and made this very point. Not speaking politically, however you feel about it, there's 2 million more people in the United States than there were 9 months ago. That's just a fact. I don't care about your politics on it, but there's a housing need, right? And not only that, that's going to affect jobs. It's going to affect everything. Now, it's just a small percentage, but if we watch the trends, we can see what's happening. If you really want to hang out with folks that are watching the trends, then come hang out with the Real Estate Guys. We have just opened up our registration for the 21st Annual Investor Summit. It takes place in June in beautiful Ambergris Key, Belize. And if you're interested in that, all the details are now on the website. Registration is open for the Investor Summit.
Yeah, it's a great time. You'll get more done in terms of your depth of understanding and your strategic connections. And if you're in any form of real estate business, whether you're a real estate agent, a syndicator, you're going to be able to make connections with a lot of the right people, some of whom are fairly notable in the space. You can get yourself a selfie, get an autographed book, picture. It's just a ton of fun. And, if you think about what it would take to build that level of quality of relationships, build a network that big, you'd probably spend 10 times the price in attending conferences and flying around in hotels. Then you can get it all done in 1 week. The price tag is big, but we never fail to sell out. Last year, we sold out 3 months ahead of time with 104 people on the waiting list. We're already more than halfway sold out just with alumni and the people who are on the advance notice list. So we don't know when we're going to sell out, but I'm guessing it'll happen pretty quick. And with everything going on in the world, this thing should not cost you money. It should make you money. One great idea, one great opportunity, one great relationship is all you're going to need. And if you think about compared to what, in terms of what you get out of it, it's not an expense, it's an investment. And if you're the type of person that's willing to invest in yourself like that, you are the type of person we'd love to hang out with. So come join us. Send an email to summit@realestateguysradio.com. Get all the details. We're still lining up our faculty. You're going to love them. We already got some great new people online. And of course, our regular cast of characters will be there. Some of the biggest names in the business, some of the smartest people in macro and Main Street. So join us, summit@realestateguysradio.com.
Hey, we've got some awesome guests coming up in the coming weeks, so stay tuned to the Real Estate Guys. If you have a question for the guys, you can go to the website at realestateguysradio.com. Click the button that says Ask the Guys. In a few more weeks, we'll do another Ask the Guys episode. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.